In this week's video, we'll focus on observable evidence that still sides with the bullish case. Here are some of the highlights for this week's video. To respect everyone's time, we'll just move through this quickly. We'll look at the 13-year breakout, update the CCM Big Four, semis materials, DeMark analysis, and the current readings on the CCM market model. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. It's a little piece of anecdotal evidence that seems to align with the bullish case. This is a weekly chart of the Semiconductor ETF SMH. Those of you that follow the markets, you know that semiconductors are a high beta or volatile name. All things being equal, when high beta does well, that tends to be bullish for the stock market. This chart goes back to 2011 here. Resistance, 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 resistance. Bullish breakout. Tested the breakout once and passed on a weekly chart. Tested the breakout again and passed. The longer we stay above this blue trend line, the better it is for semiconductors and the better it is for the general market. Obviously, if we fill this white space here, the inverse is true. If you're a disciple of How to Make Money in Stocks or IBD or William O'Neill or CanSlim, you know that a cup and a handle pattern and a bullish breakout from that, from a probabilistic perspective, this can be a bullish setup. The EFA ETF on a daily chart has done just that. It's a bullish breakout from a cup and handle pattern. As long as EFA can hold this blue line, it tends to lean bullish for future outcomes. So now the chart used in one of the submodels for the CCM market model. We're looking at a weekly VIX here. You can see when the VIX drops below the moving average cluster, the colored cluster here, when we drop below, good things tend to happen in the stock market. Below the cluster here, the VIX is falling. Stocks do well. Below the cluster here, stocks do well. Drop below the cluster here, the stock market does well. We close this week near the cluster, but below the cluster. VIX at 1416, and these are your MAs here, close below them all. You can make an argument that this T here looks similar to this T here, where gains on a weekly basis followed. So as long as this chart remains like this, it seems to be gravitating back towards the bullish case. If the VIX pops back up above these moving averages, it actually becomes bearish for stocks. It's a weekly chart of the NASDAQ composite. Those of you who watch our videos know that the market model looks for changes in observable evidence. Good things tend to happen when the slope of the 22-week is positive. It's still positive. Good things tend to happen when price is above the 22-week, still above. And we'd like to see momentum remain in overbought territory. Not too many bad things happen when you're in overbought territory. We're still in overbought, still above, still with a positive slope. Similar situation on the daily NASDAQ, slope of the 50-day up, price above, slope of the 200-day up, price above, momentum still in overbought territory. What once was a laggard became a leader this week. The Dow Jones Industrial Average shot up 453 points this week, or up 3%. It was able to recapture the 22-week moving average. Price is above the 22-week, and the slope of the 22-week is positive. Good things tend to happen. We still have both here, as long as that remains in place. From a price perspective and a trend perspective, this chart leans bullish. Similar improvements on the daily chart of the Dow. The Dow was able to recapture the 50-day moving average this week, and the slope of the 50-day has turned up. You can make an argument that this looks similar to this period here, where gains in the stock market followed. Bullish momentum here, good things happened. Bullish momentum, we're still in overbought. Slope of the 200-day, positive, price above the 200-day, indicating that the long-term trend is still bullish. We looked earlier at the 22-week moving average for the NASDAQ. Now we're looking at a weekly chart for the S&P 500 as of the close on Friday the 13th. Price above a positive sloping 22-week moving average, and weekly momentum has recaptured negative 20 here. Good things tend to happen, all things being equal, when you recapture negative 20. One of the basic tenets of trend following, if you use moving averages, is you look at slopes and you look at where price is, and you also look at moving average crossovers. So as we know, price below moving averages and the slopes of the moving averages rolling over, and faster moving averages crossing below slower moving averages tends to be bearish. Conversely, when we have the mirror image, slopes up, faster moving averages crossing over the slower moving averages, and price above, good things tend to happen in that environment. What we have now is what appears to be something similar to this period here, or this period here, or here. We're trying to turn back up and reestablish a bullish trend. If we look at this chart a little bit more closely, we can see that the S&P 500, or price, is above a bullish and upward sloping 50-day. We have the exponential 20 and the exponential 40 trying to turn up in a bullish manner. Their slopes are positive, and blue has crossed slightly above red, which is also bullish. Next in line, we'd prefer to see the red and the blue, or the faster EMA 20 and EMA 40, cross back above the 50-day moving average as they did here and as they did here, where gains in the stock market followed. The CCM market model uses numerous moving averages on daily, weekly, and monthly charts. Just another look here on a weekly chart. You can see typically when you get price above green above pink, green and pink above blue, and blue above red, good things tend to happen. We're trying to take that look back now with green closing above the pink this week here, and the slopes trying to turn back up. As long as this look holds, it leans towards bullish outcomes. Taking those trend following concepts out to a monthly chart, I don't think anyone can look at this chart and say that this wouldn't have been helpful. Bearish look, bullish look, good things happened. Bullish look, good things happened. Bearish look, bad things happened. The current state of this long-term chart remains bullish, price above both moving averages, and the slopes of the moving averages are up, and the faster EMA 3 on a monthly blue is above the slower EMA 10. Looking at a daily S&P 500, you may say, Chris, this is boring. We know all this stuff. Well, if we know it, we should use it, and we should convert it into a usable format, and that's what the model does. This stuff is easy, and it's important. 50-day S&P 500, we've recaptured it. All things being equal, the bulls would prefer to stay above it. Slope of the 50-day is up. You can see not too many bad things happen as long as the slope of the 50-day remains up. You can see a little hiccup here, bad things happen, and then we quickly recovered, and the slope recovered as well. Indecisiveness here, then it turned back up. We also have momentum on the daily chart of the S&P 500, recapturing in a convincing manner Williams percent R negative 20, where typically when that happens, gains in the stock market follow. Revisiting a chart we've looked at numerous times. This is the SP 500 Monthly dating back here to the year 2000. Resistance. Monthly chart, resistance again in October of 2007. Present day, we get a bullish breakout on the monthly chart followed by a successful retest here. The longer the stock market stays above this blue line, the higher the probability of I can't understand it type gains that could come out of this chart. This is a 13-year consolidation period. We've broken out of the base. None of us know what will happen in the future, but we all know that a 13-year breakout usually has bullish implications. If you want to take the glass half empty look, we also know that failed breakouts of this nature can lead to accelerating losses to the downside, which is why the blue trend line here is still important from both a bullish and bearish perspective. As it sits now, it leans bullish. This is the weekly version of the same chart. You can just see the retest here a little bit more closely. Resistance, resistance, bullish breakout here, and a retest here. And now we have a bullish trend with a series of higher lows and higher highs. If you're relatively new to the world of technical analysis or our videos, or if you just want to learn more about the market model, the game plan this weekend is to swap out some of these videos to remove this European debt crisis, slide this About Us video down here, and there should be a new icon here, if all goes according to plan, later in the weekend, where we will have a video posted that explains some of the concepts behind the market model from a non-technical perspective. The front end of that video, just the first few minutes, has some new information. The back end uses the analogy between the market model and weather that many of you have already seen. And now we'll move back on to charts. If you plan on building a model of your own or a systematic approach to managing money, you want to make sure that your model passes the "that makes sense to me" test rather than curve fitting a model to data. You should build the model and then test it. Treasuries relative to the S&P 500. Point of the exercise: does trend following help? Does risk on, risk off help? Does monitoring visible and discernible and observable changes help? This is the summer of 2008. This ratio here is TLT, or conservative treasury bonds relative to the stock market. So this is what risk on looks like. Bonds are underperforming stocks and the stock market does well. Here, when bonds are in greater demand, the stock market does poorly. From a trend following perspective, the bullish moving average crossover and the bullish look forms here in June of 2008. There's your cross, price above. This is a full bullish look. The S&P 500 is trading at 1355. This chart never says to switch back to stocks. It says stay in conservative assets. Between the signal here in the summer of 2008, the S&P 500 dropped from 1355 to the Damian low of 666. As we noted earlier in the video, when higher beta or cyclical type ETFs like semiconductors do well, that tends to be good for the overall risk profile or risk tolerance or acceptance of risk from investors. Same can be said for materials. You can see materials here on a weekly chart. A triangle formation. We get a breakout, somewhat of a retest. We're back above. You can see XLB was up over 2.6% this week. All things being equal, as long as this stays up here, that tends to be good for stocks. Between now and the close of the video, we'll sprinkle in the CCM Big Four charts. The most important chart in one of the submodels is the SP 500 itself. Why? Price is the most important thing. We do use indicators and other methods. They just carry a lower weight, quite a bit lower weight than price in the model. Somewhat of a mixed bag here, but an improving look. We have price above on a weekly chart, and you can see that the blue did eke out a positive close relative to the red. So we did get a bullish moving average crossover here, and you can make an argument that this looks similar to this period here where gains in the stock market followed, or similar to this period here or here where gains in the stock market followed. Can you get whipsaws? Absolutely, you can get whipsaws. The purpose of the models and what we're doing is we need to see a whipsaw or observable evidence that shows us a bearish flip, which may come with the Fed next week. It may not. The model also looks at numerous indicators. You can see CCI held the zero line here on a weekly chart. The force index, all things being equal, you'd rather have it close above zero on a weekly chart, which it did. MACD histogram is trying to tick back up. Weekly RSI for the S&P 500 remains at 61, which fits in well with a bull market profile. You can see rate of change recaptured the zero line. We got a bullish crossover on the full stochastics, black above red. This is all tracked by the market model. Stochastic RSI came out of oversold territory, works the same way here. Better things tend to happen. You can see stochastic RSI comes out of oversold. Here's the S&P 500. Good things tend to happen. Out of oversold on a weekly chart, good things tend to happen. We came out of oversold here, all things being equal. That tends to be a positive for the stock market. Weekly ultimate oscillator trying to hold 50. You can see we held 50 here, and gains in the stock market followed. Williams percent R, similar situation, held negative 50 or the center line similar to this point here, and has recaptured negative 20 or the positive overbought territory where good things from a probabilistic perspective tend to happen. It's a chart we've looked at numerous times. You're looking at hedging, or HDGE, which is basically a short ETF relative to the S&P 500. You can see here risk on. In this case, this ratio falls during risk on. When there's greater demand for HDGE relative to the stock market, as we can see this turn here in the ratio, bad things tend to happen in the stock market. Ratio turns up, stocks correct. Here we have the ratio not turning up in a bearish manner for the stock market, but instead continuing a bearish trend where we're getting a series of lower lows. We made a new lower low this week, and a series of lower highs, which is the definition of a downtrend. A downtrend in this ratio tends to be positive for the stock market. As long as this look holds, it sides with the bullish case. This is chart 204 of the CCM Big Four. It helps us answer the question, would I rather be long or would I rather be short the S&P 500 from a trend following perspective using a weekly chart and moving averages. This is the ratio of the S&P 500 relative to shorting the S&P 500. Why do we look at this? What helps us answer this question, you look at it on a relative or opportunity cost basis. Here, I'd rather be short the stock market, and here I'd rather be long. I'd rather own SPY than SH. Here, I'd rather own SH than SPY in instances like this. The current look of this has flipped back to bullish, short correction, flip back to bullish, gains followed. Similar to all the other charts, as long as this remains With the current look, it will check off positive or bullish boxes in the model. If it morphs back into something like this, which it may, it will start to check off bearish boxes in the model. And like many of the other weekly charts, Williams %R did recapture the -20 level where good things tend to happen for being long relative to being short. If you're positioned for bearish outcomes and you're looking for a chart that might side with that case, and we're neither bulls nor bears, whatever the charts tell us, that's where we'll go. Currently, they're migrating back to a bullish stance. However, chart 3 of 4 of the CCM Big Four, stocks relative to bonds, would I rather be in stocks? This look. Would I rather be in bonds? Is this look. Like many of the other charts, it is converted back to a bullish look. Blue closed above red, price above both, slopes are going up. However, from a potential resistance standpoint with the Fed next week, this chart has not cleared the July high here. So the blue line might act as potential resistance. And then what once was support may now act as resistance. The pink line could also repel the ratio here and flip the markets back toward risk off. How do we use these lines in the model? The answer is we don't. If this happens and these trend lines do repel price, then price and the models will start to deteriorate, and we'll take care of it and we'll migrate away if we have to. What we don't do is guess that this will act as resistance or guess that this will act as resistance. When observable evidence aligns with this acting as resistance or this acting as resistance, then we take action that's in line with the severity of the deterioration. The faster we deteriorate, the faster we move away. If it's somewhat tepid deterioration, the model will step away at a much slower rate or simply hold its present course. Nothing really new to report here on small caps. We still own them and have owned them. Price above blue, price above red, blue above red, slopes of all of them up. It did recapture Williams %R -20. All things being equal, that's a positive from a probability perspective. It's a different perspective or look on materials. This time it's the IYM weekly. You can see we've got somewhat of a triangle formation here. We're trying to break out for about the 15th time on this chart. If we can hold above this level here, like semiconductors, all things being equal, that would tend to be good for the stock market. Weekly chart has a bullish look from a trend following perspective and has a MACD that looks like it's trying to start to turn back up. This is chart 4 of 4 of the CCM Big Four. Doesn't carry a heavy weight in the model. We're looking at JNK or riskier or higher yielding bonds relative to more conservative and lower yielding treasuries. This is what risk on with the ratio looks like. This is what risk off looks like. Bullish look, bullish here as well. We've tightened up our quality control a little bit this week. Now we have Tommy Hilfiger versus toothpaste, or XLY versus XLP. This chart, here's the SP 500, still has a risk-on look as well. This week's video gave a very small sample size of what we track in the market model. This is the master spreadsheet. This is where we do some of the threshold analysis here, and you'll notice zeros and ones are binary. You're comparing the present day market to past profiles here. A 0 and a 1 has no room for bias or opinions, and that's the strength of what we're doing here when we pay attention. The models here, all of the inputs really congregate around giving us two numbers. What's a prudent exposure on the risk side of our portfolio, and what's a prudent exposure on the more conservative side. You can see the model here in late August when the markets were weak allowed us to manage risk. Why is that important? If the market didn't right itself here and August was looking similar to October of 2007, and the market never righted itself, we would have already reduced risk and we would have been able to step away and eventually get this in line with market conditions. Instead, the market did find its footing, and it's always difficult to understand why the market's finding its footing. But the model allows us to ramp back up from a 44 on August 27th all the way back to 80. What the 80 tells us is what the market's profile is as of the close on Friday, September 13th. It does not tell us what next week has in store other than, from a probabilistic perspective, the answers to all the questions now obviously tend to align with bullish conditions, and you just saw that in the video. What it doesn't tell us is how long those conditions will remain in place. We assume that they remain in place until we see observable evidence to the contrary. It's a daily DeMark chart for the SP 500 index. We'll move to the SP 500 cash index. Next, DeMark charts and indicators are proprietary tools from Market Studies LLC. Last week, we looked at a deferred 9 paired with a 13 on the S&P 500, and we said that if the market was able to recapture the 8-bar closing level, in this case on the futures it was 1683, if it were able to hit that level even intraday, that the deferred 13 with the asterisk would turn into a completed 913 count, which can signal potential trend exhaustion. We did get it. If you look at the high here on the 11th, it was 1684 even, and here you're at 1684. So we needed to meet or exceed it, and we did that, and you can see the 13 is associated with this day. What does this mean? It tells us from a probabilistic perspective that the probability of this trend being exhausted between this level and say 1707 to 1712-ish, it's a higher probability, and it's just something we have to watch for. How do we use it? It's good to be aware of it, and if the market does reverse in this area and the evidence starts to deteriorate, then it's easy to understand why it would make sense to consider stepping away. Presently, this is just a setup. Now we're looking at the same concepts applied to the S&P 500 cash index that most of us know and love. Nothing's really changed here. We did not get to the 8-bar this week. We came relatively close. So if we hit 1695.53 next week, these asterisks will turn into a number 13 and we will get the completed 913. Also note from a propulsion perspective, the magnet on the upper end is still that 1632 that just won't go away. As long as we stay above 1669-ish, 1732-ish is still in the picture. If we break below 1669, then from a momentum perspective, 1648 and change is the downside magnet on the daily chart of the S&P 500 using DeMark indicators. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.